If you work for a public company, you probably get some of your compensation in the form of RSUs. But what are these things? Here are 8 things you should know about your RSUs. And make sure you stay until the very end, where I'll give you the most important question you should ask yourself as your RSUs vests. This question will bring a lot of clarity and help you decide what you should do with your RSUs. But first, the 8 things you should know. Number 1, what is an RSU? RSU is short for Restricted Stock Unit. It is awarded by a company to an employee for a specific number of shares of the company's stock once the employee has met the conditions of the award. The most common condition of RSUs is staying with the company for a stated period of time. If you don't stay with the company long enough, you could lose some or all of your RSUs. But if you meet the terms, your RSUs will vest. Number 2, what type of vesting schedules are there? There are typically 3 types of vesting schedules. Cliff vesting is an all or nothing type vesting schedule. If an RSU has a 3-year cliff vesting schedule, then 100% of the RSUs will vest at the end of year 3. Graded vesting is a more gradual vesting schedule, where portions of the total grant vest over time. If an RSU has a 4-year graded vesting schedule where employees vest 25% of the grant per year, then the employee will earn a quarter of the shares each year. Hybrid vesting is a combination of the two. Typically, an employee will cliff vest a portion of the RSU grant, and the remaining will vest over a graded basis over the remainder of the term. As an example, over a 4-year vesting period, 50% could vest at the end of year 2, and the remaining 50% will vest in equal portions over the following 2 years. Companies can devise their own vesting schedules, so make sure you understand how your RSUs vest. Number 3, what happens when RSUs vest? Vesting occurs when an employee meets the underlying conditions of the grant. At that time, the employer gives the employee the promised number of shares of stock in the company, and the related taxes must be paid. Don't worry, we'll talk about taxes next. If an employee leaves or is terminated before the conditions are met, then the shares are never transferred to the employee because vesting never occurs. Once the RSUs vest, the employee now owns shares of the company. Number 4, how are RSUs taxed? RSUs are taxed when they vest. The employee will recognize income equal to the number of shares vested multiplied by the share price at time of vesting. For example, if an employee has 10 RSUs vesting and each share of stock was valued at $100 at time of vest, then the employee would recognize wage income of $1,000. This income would be subject to not only federal and state income taxes, but also Social Security up to the annual limit and Medicare. Number 5, how will the taxes be paid? There are essentially 3 ways to pay your taxes upon vesting. Number 1, a cash exercise. This means you will pay your company the related taxes for the vested shares, and you will keep all of the shares. Number 2, sell to cover. This means you sell enough shares to cover the taxes, but you keep the remaining balance of the shares. Number 3, sell all the shares. This is commonly referred to as a same-day sale or settle for cash. At this time, you essentially sell all the shares and keep the cash. It's worth pointing out here that your RSUs are effectively a bonus based upon the value of the shares. You can decide to keep all the shares, sell all the shares, or some combination of the two. If you elect to keep the shares, you're essentially buying them at the current price. If you keep the cash, you'll never have to deal with owning the shares. Make sure you do what's best for you, depending on your long-term financial goals. Number 6, what is the tax rate on my RSUs? Most companies will withhold federal income taxes using the federal supplemental wage withholding rate, which is 22% on total income up to $1 million and 37% for income over $1 million. However, if the employee is a high earner or is married to a high earner, the actual income tax rate could be significantly higher. The top federal income tax rate today is 37%. Therefore, a high earner with a significant amount of vesting RSUs could be in for a nasty income tax surprise come the next April 15th if they are not adequately prepared. Do not mistake the withholding rate on the RSUs for your individual tax rate on your income tax return. Number 7, what happens once I own the shares? Once you own the shares, they are subject to the same tax treatment of any other stock you may own. The sale will result in a capital gain, and the gain will be classified as short-term or long-term, depending on how long you hold the shares. If the shares are held for less than a year, the gain will be taxed at short-term capital gain rates, effectively ordinary income tax rates. Shares held over a year are taxed at the preferred long-term capital gains rates. The holding period begins when the shares vest. The amount of gain recognized on the sale of the shares is the sales price less the amount of income that was recognized when the shares vested. If the RSUs vested over a number of years, you'll need to keep track of the income earned on each tranche. When you sell, you can determine which tranche is the most consistent with your income tax planning strategy. Your custodian may keep track of this for you, but it's not a bad idea to keep track of this for yourself to ensure that it is done correctly. Number 8, what should I do now that I own the shares? Having too much of an employer's stock can be risky because not only are you dependent upon your company for your employment, but you may also develop a highly concentrated stock position relative to your net worth. If something happened to the company, not only could you lose your primary source of income, but your net worth could take a significant hit as well. Make sure you have incorporated these shares into your comprehensive personal financial plan. So what is the question you should ask yourself when your RSUs vest? Well, it's a fairly simple one. If you had the cash that the shares were worth, would you use all of that cash to purchase the shares? For example, if your RSUs are worth $100,000, would you use all $100,000 to purchase the shares in your company at this time? If the answer is no way, then you should probably look at strategically selling shares to align your asset allocation to your financial plan. If the answer is yes, then just be mindful of the concentration that may be developing within your portfolio. So there you have it. I hope you find this helps you with your decisions regarding your RSUs. If you like this content, please hit like and subscribe. I did another video on how to reduce income taxes by giving more to charity. If you have a significant vesting event happening this year, you'll want to watch this to see if any of these can help reduce your income taxes. You can find a link to that video here. Thanks for watching, and I'll see you next time.